we are doing question one, right? We are doing question one. So this question one consists of 35 marks. So the required reads as follows. Right, calculate the taxable income of Hlasela Private Limited for 2023 year of assessment. Provide reasons for amounts that have a nil effect on taxable income. So the question is saying calculate the taxable income, not tax liability, but taxable income. Right. The taxable income is the amount that you will apply the tax rate on. That's the taxable income. It's the amount that you'll apply the tax rate on. Now we're using 27. So you're going to say times 27, then you get the tax liability. All right. But the taxable income, that's why it's saying the taxable income. So that income that you have at the end is the income that you would then apply the applicable tax rate or the tax tables if it's a small business. Okay. So know that there's a difference between tax liability and taxable income. Tax liability is the amount that you need to then pay over, right? Calculated from the taxable income. So it's going to be like this. So normally it's your taxable income. All right. So it's more or less like your profit before tax, yeah. It's more or less like profit before tax. That's similar, right? So on this amount, let's say it's 10,000. Therefore, your tax liability, if the question says calculate tax liability, right? You then come and what? Multiplied by what? 27% of this amount. That is your liability to SARS. So your liability is not this amount. This is the income balance, okay, after getting all the deductions according to the what? Sections of taxation. Then from there, you multiply by the applicable rate, you get your tax liability. So these are different. All right. So the question wants this figure. They don't want you to go all the way here. So it reads as follows. Hlasela Private Limited is a company incorporated in South Africa with 30 April financial year end. The company manufactures and distributes weight management supplements, pharmacies, and retail food stores in and around South Africa. The South African Reserve Services regards Hlasela's manufacturing process as an approved process of manufacture. Why are they saying you approve? They have to approve you. All right. So the reason why they will be approving you is because it is not all machines that are manufacturing that qualify. So if you qualify, it's as a simple saying that whatever machine you buy, you can use the what? The tax rules. Okay. All right. Hlasela is a registered VAT vendor for VAT purposes and making only taxable supplies and is not a small business. Right, not a small business. So if it is a small business, we did a small business last week, although we didn't finish the question, but we did small business. It's just about the rules, the difference on how you treat manufacturing machine and non-manufacturing machine. Okay. Then they're saying all amounts exclude VAT unless otherwise stated. Otherwise, all amounts exclude VAT. All right. Then they are saying Hlasela's primarily taxable income was correctly calculated. Sorry, preliminary taxable income was correctly calculated as 2,340,000 before taking the following transactions into account. So that means so far they calculated whatever deductions they qualify for as a company, and then they got that figure. Then more transactions came during the year. So we've got our preference shares. So preference shares, what happened? On 15 June 2022, 510% preference shares were acquired for what? For 175,000 from Agro Limited, a South African resident company. During the 2023 financial year, dividends amounting to 34,870 were received in respect of the shares. So the first thing that you should connote or consider when they throw dividends at you, right, is it a local dividend? Okay. Is it a what? A local dividend. Okay. And then before you consider that, by the way, you start off by asking yourself, did I receive that dividend or did it accrue? So if it's accruing, that means we are saying you are entitled to receive that, even though you have not yet been paid, but you are entitled. It's like your salary. 25th, the company hasn't paid, but after that date, you are entitled to your salary. So sometimes the dividend is not paid, right? So it is accruing to you. So you are entitled to it. So you record it as part of your income. That's why you don't put brackets. Okay? You record it as part of your income. It's taxable. But remember, any dividends received from a local company, whether DSTV, which other local company? Just gone blank. Right. Local companies, if they pay dividend to you, right, it is exempt. Okay, it is what? Exempt. So you first include it in to indicate that it qualifies as gross income from section 1, and then according to another section, section 10, right, IK, right, SARS says any local dividends are deductible. So you subtract it. So you include it and subtract it. Okay. So that is the story. Then we'll get to foreign dividends. Right. And then investment in fixed deposits account. 5 years ago, Hlasela invested 100,000 in fixed deposit account. This investment yielded interest amounting to 15,800 for 2023 financial year. So the interest is taxable. It is income. Okay. The interest is taxable. It is income. All right. No rules here. So it is like that. But we'll get to a point where we are doing individual tax, like taxation for you, for your individual tax returns. And then things will change a bit when it comes to interest. But otherwise, any interest received from a dividend, from an investment is gross income. So it should be included. All right. There, hence, all right, I included no brackets. So if you are going to write these questions, if you make a mistake with your brackets, that means you don't understand your text, what you're doing. Income, you are adding because you've made the income. SARS wants to tax the income. So income should increase your incomes, your other incomes. And then whatever you're allowed to deduct according to the sections of tax, you put brackets to reduce your income. Remember, your point or your aim is to be taxed as less as possible. So the more the deductions, the less tax you will pay. That's why it's important to know the rules, right, that apply to deductions and how much. Sometimes not everything, but they will say subtract a portion. Okay. So tax is very interesting. Right. So let's go into foreign dividends. Right. Ordinary shares with a total share price of 500,000, correctly converted to the South African rands, were acquired from P Public Limited, a foreign company. All right? So it's a foreign company. So already it's a foreign company. That means there might be foreign dividends. The ordinary shares translate to a 5% shareholding and voting rights in this company. Okay, voting rights in this company. During 2023 financial year, dividends amounting to 108,000 accrued to this one in respect of the shares. So you have not received the shares, but you are now entitled because the company declared them and said, guys, we're going to pay you dividends. So they've declared them, you are now entitled. So as long as SARS, as long as that news reaches the ears of SARS, that means that dividend is accruing. So you are supposed to include it because it is income. All right. But now it's going to depend. Okay. So now there's a rule. What is the rule? If you're holding less than 10%, where is this? Okay. All right. These guys are holding this. So as long as you are holding less than 10%, all right. That means from this portion that you received, remember you received. So SARS wants to tax the full amount. SARS wants to tax the full amount. But because it's a foreign dividend, it's received from a foreign company, so it's a foreign dividend. SARS says if you are holding less than 5%, all right, the portion that will not be taxed from what you received is 8/40. Right. That portion will not be taxable. So you decrease the amount that you received by the 8/40. Then you're asking Jeffrey, what if it's what? What if it's 10% and more? Right? The full amount is exempt. All right. Meaning to say you're going to indicate by first including because it is gross income. Then if you're holding 10%, all right, and more, you come and deduct it again in full. All right. But if you're holding less than 10%, that means 8/40, it's a fraction of this figure, is the one that won't be taxed. Okay. That is what I did over there. Then that portion is the one that is exempt. So you can then come and say for yourself, you can say less than 10% so that you excite the examiner, right? Or the lecturer, whoever will be marking. But if you want, just do it this way. Then you're done. Right, then you'll be done with that transaction. Then we go into the second one. Right, we have once covered Forex. Forex what? Acquisition. Okay. So it's saying on 28 Feb 2023, all right, Hlasela acquired a new processing machine for use in the manufacturing process from a supplier based in America. The machine was acquired for $40,000 US and shipped on board shipped on a free on board basis. Right, the machine was loaded on the ship at the American harbor on 6 March 2023 and arrived at a South African harbor on 17 March. So we don't care about this arrival date. All right, so cancel it out. If they say arrived, don't care. We don't care when it arrived. Our main focus is what? The free on board date, when our asset got onto the what? Transportation, right? Unit, whether it's via air, which is an aeroplane, or via sea. Okay. when it's now free on board. So it's now freight on board or free on board, okay? All right, that's when we start to account for it. So meaning to say that when we're now accounting for this, SARS will say, okay, how much is the cost? So the cost is based on the rate, on the what? Freight on board date. The cost is translated, right? Okay, using the rate on free on board date. So sometimes the question will give you the order date. They will say you ordered. All right. So the order date, we don't use it. Ordering something doesn't mean that you're going to get it. All right. But we are concentrating on the what? When the freight is on board. Okay. Then at that rate, we translate the foreign currency. So here, this was 6 March. So you come to 6 March. What was the rate?
18 pesos.
18 Rand 13 cents. Right, 18 Rand 13 cents. You translate. Okay. Then they are saying, so please ignore the arrival date. They just confuse the dates to confuse you. Right. Additional costs amounting to 15,000 were incurred for assembling and mounting the machine. So these are the costs to capitalize because they form part of the cost. Because without this cost being incurred, the asset was not going to be ready for use as intended by management. So we need to also capitalize that cost. You add it to the amount that you get when you multiply the spot rate and 40,000. There you go, right? 40,000 US multiplied by 18,13. I got that figure. You come and add the additional costs, then you get a new cost of 740,200. Okay. All right. Then from there, you ask yourself this question: what am I dealing with? I'm dealing what kind of a company am I dealing with? I'm dealing with not a small business. Then the machine that I acquired, is it a new machine or it's a second hand? Or it is a new machine, right? So a new machine, the cost that you incurred, you claim 40% in the first year. Then the subsequent years, you claim 20, 20, 20, all right? So in other words, we are saying you claim the costs that you incur on manufacturing on buying a new manufacturing machine over 4 years. 40, if you add these, it gives you 100. That's how you know. So someone will say, how do you determine the years? When you bought it, the year you bought it is the first year, right? Then the other years you claim 2020. So in total, you are claiming over 4 assessment years, okay? If it's a second hand, you claim 2020, 2020. That's for a manufacturing machine, not just any machine, manufacturing machine. Okay.
You're welcome.
So that's what you do there. I took the 40 because it was, yes, also watch out when it was brought into use. Right, when was it brought into use? On
1 April.
So it's within the tax year. I even took the liberty to write. I usually do this. I like to write my year so that I don't get confused. So we bought it 1 month. We brought it into use 1 month before the year end of our tax calculations. So you claim the full 40. You don't apportion. You don't say 40% times 1/12. You claim in full, even if it's 1 day before year end. So you get your amount of cost that you are claiming. Okay. Right. Then the other thing, remember, we consider the movement. We consider the movement of our spot rate. Why? Because on the date when this when the freight was on board, we didn't pay anything. So now we are saying, if we reach the year end, which is that April, right? if we reach the end without making a payment, then we're supposed to then compare the rates. What has happened to the rate? All right. So on 30 April, the rate had gone up. Remember, we are paying. So as long as the rand is losing value, then we will need to convert more rands to cover the what? The US dollar.
The dollar.
Exactly. That's how Forex operates. So that is why currently, right, it is a big risk to import. Okay? Because you're now losing out on the exchange rate. That's why whatever you bring in, you need to sell it at a higher price to try and recover that spot rate differences. So it's not viable because it makes making the prices, because you want to cover the spot rate changes, because the rand is on 19 now, so it's not good. Okay, it's actually better for those that are outside the country that are sending the forex here, because you change and you get more rands. But if you want to pay a foreign company, you need to change the rands. You need more rands to equal the foreign US dollar or the euro. So there's a loss. That 18,13 minus 18,28. That minus that multiplied by the debt that you owe, right? That is a foreign exchange loss. So SARS allows you to deduct that expense. If it was income, you're going to add it. If it was income, you were going to add it. Are we together?
Sorry, Jeff, I missed something here. That 15,000 of additional cost, where is it coming from?
It's in the question. Okay.
Oh, okay, sorry. Okay.
Yes. All right. Then you'll be done with the number 2, information. Then we come to number 3, information. Hlasela leased building 11 from Property Limited to house its manufacturing processes. Right. The lease contract stipulated the following. Commencement date is 1 Feb 2000 and what? Right, is 1 Feb 2011. Okay. Right. The lease term of 12 years. So this thing is for 12 years without an option or for extension. So if the question had said with an option to extend, you're going to say plus. So if you want to extend for 5 years, you're going to say 12 plus 5, just in case you get that on Monday. But if there's no option, then you take what you're given. But if there's an option, extension option, you add it to the initial what? Lease term. Don't forget that. You add it. Okay. Then the lease premium of 55,000 payable in full on commencement date of the lease. Annual rental of 85,000 payable in arrears, subject to a 10% escalation after every 6 years. Improvement value at 480,000 had to be effected on the building in the first year of the lease. The improvement commenced on 10 Feb 2011 and was completed on 30 March 2011 at a cost of that. The whole building was brought into use on 1 April. On 1 April 2011. Okay. Then they're saying only 40,000 of the lease term was included in the lessor's gross income. Right, so here we have section 11G, right? Section 11, small g, which is annual leasehold improvements. And then we have a premium, which is section 11F. Right, premiums are governed by section 11F. And then the leasehold improvement are governed by section 11, small g. So it happens that if someone has got land, they say, you want to use my land? Yes. Oh, okay. But can you effect improvements on my land? So you need to spend. And then after your lease term, you leave everything. You don't demolish, no, you leave it. That's the condition. So that normally works for companies that know that they're going to make a lot of money from that land. Because sometimes you find that I've got a nice farm, yeah, I've got land maybe next to something, and you guys want to start a project there. So I can allow you, say 20 years, it's fine. Build, do whatever, it's fine. But when you guys leave, you leave me with everything, the rooms, whatever is there. That's the condition, it happens. So that's what's happening there. So what's important when you get a question on leasehold improvement is, when is the commencement date, number one. Okay, so the commencement date is that. Number two, you ignore when the improvement started. Ignore, I said what? Ignore when the improvement started. And use completed. Okay, so with this one, you need a timeline, a good timeline. Okay, so this thing is 12 years, right? So it's 12, like literally 12 years. So commencement date, you started there. It was what? 1 Feb 2011. Okay. And then remember that 2011 year was the ending on 30 April. So there was only 3 months of the 12 years. All right. And then now you need to count the full 12 years. So 12 years, remember, from 1 Feb 2011 to 30 April 2011 is 3 months. Then from 2011 to 2012, it's 1 year. From 2012 to 2013 is 2 years. 2013, 2014, 3, just like that, until you reach what? 2011. It's 11 years gone. And this thing is 12. So 3 months were used in 2011. How many months are left?
9.
Okay, then that's the full 12 years of the lease. So watch out for such things. Okay, and then from this point, you then need to calculate the what you call this, the leasehold improvement. What you can claim from SARS, right? There's a formula. Okay, leasehold improvement. So you first change these years into months. 12 years multiplied by what? By 12 months, you get what? 144 months. And then SARS says, okay, the months when you're improving the place, digging, buying material, people building, wasting time, and all those things, that period of you improving the place should not form part of the what? The claiming, right? Of the what? Of the allowance. It should inform what? Part of the claiming, because SARS at that point was not sure whether you're going to complete the building. So anything that you were incurring during that time should not form part of the what? You claiming the improvements that you have what? Effected on someone's property. It's you claiming the one that is leasing the place because you are improving someone's property. Right, so you always have to remove the improvement period, months. So you started what? So that means you always start from the commencement date. And when did you complete the improvements? On 31st March 2000 and 11 improvements completed. Right, so you stop there. So that's how many months? 2 months. So you come and remove the 2 months. How much are you left with?
142.
142. And then when you're now claiming, the formula is, right? Remember, there's a contract. This thing is all about a contract. So the contract will have an estimate of the cost you're supposed to incur. All right. So the estimate for this question, the estimate was how much? It was 480. They thought that you're going to spend, right? Or these improvements will cost you 480 as the one what? Leasing the place. But how much did you actually incur? 550. So when you're now calculating the allowance you're allowed to claim from SARS, you always take the lesser of 480 or 550, whichever is lesser. All right, that's what you use to claim. So there is your calculation. All right. So I subtracted the 2 months that I was doing the improvement. So always count, and you always start from commencement of the lease, not commencement of improvement. Ignore when you started the improvements. Always start from the commencement. I don't know why. I don't understand why, by the way. I've tried, but I don't get it. Okay. So that's the mistake that I used to do when I was doing this module undergrad, right? I would remove from improvement period, but that's not the case. It's always from when you entered the list. Okay, so remove that, you get that. From there, you then divide. So always take the lesser between the estimated cost you are going to incur and the actual cost that you incurred. Then you multiply it by, yes, Wakang?
Good evening, sir.
Then you divide that. So always convert it to months. I think it's better. Some use years. I just use months. Then when you go to your calculation, remember they said, when was this brought into use? Brought into use date is for SARS, by the way. Brought into use 1 April 2020, 11. So that means in 2011, they claimed for 1 month. Okay, they claimed for what? For 1 month. But we are not in 2011, we're in 2023. Okay, so here they just tried to be creative. Normally, you get these things happening in the tax year that you are in currently. That's where you enter that, so it's easier. But for this one, they just wanted to be creative. They just wanted to see how creative people can be. So that means in the current year, right, if you go back to your timeline. So that's why I said on my timeline, I made a mistake. All right, on my calculation that I sent you as the solution. Okay, it was supposed to be 9 months. I used 10 because I went on to 28 Feb, right? So that's my mistake. So the correct calculation will be 480 because it's the lesser between the estimated based on the contract and the actual over the remaining months multiplied by what? 9 months. Because for all these years, we have claimed the allowance. For the past 11 years and 3 months, we have claimed. So 9 months are left to claim. Then you get your answer. So that's an error from my side, but it shouldn't derail you because it's just an arithmetic error. So the answer becomes 30,423 only. So correct that. If you're a vigilant student, just correct that. All right. Change this 10 into 9. Okay, so there you go. All right. So if we were in 2011, if this was asked in that year, 2011, let's say we are in 2011, that means here we're just going to write 1 month when the asset was brought into use. It was brought into use on 1 April and the year end was 30 April. So 1 month only. Normally it's like that. But here they just try to be clever. Okay, so at least you have seen both sides of the coin. All right. And then what happens is SARS allows you to claim if you spend more than what was estimated. All right. If you spend more than what the contract had estimated, you can claim 5% each year on the difference between the figures. All right. You claim on the difference. Because it's like you're traveling for going for a trip. You think you're going to spend 10,000 for the weekend in Durban, right? At Durban, July. But you actually spend 15. So the difference between 15 and 10, the 5,000, you claim at 5% per year. So the rate doesn't change. You don't apportion, just 5%, 5%, 5%. That means it's over 20 years because 100 divided by 5 is 20. Right, so that's the trick. So someone is asking, I thought someone will ask, what if I spent less than the estimate? Then this won't be there. You don't have that leasehold improvement allowance. Okay, this last one won't be there if you spent less than what was estimated. But if you spend more, always remember the 5%. It's a fixed rate. All right. And then we've got our lease premium. So lease premium is governed by, as I said, section 11F, right? Of the allowable deductions, general deductions. So here, this was the lease premium, right? That this guy charged us. It's an upfront payment that landlords or whoever, owners of landlords want the tenants to pay upfront. So SARS says if you are the lessee, the one that is incurring the cost, you claim it over the lease term. You claim it over the lease term. Okay. So with this one, this was 55, but only 40,000 of the lease term was included in the lessor's gross income. So SARS is also limiting us. So it depends on how much SARS taxed the owner of the land. So if you tax the owner of the land 55,000, then we're going to say 55 divided by 12 multiplied by, since we're in the current year, it's going to be multiplied by 9 over 12, not 10. So I've been using 10. So that is my error there. But we are saying that, so since this one is the amount that will be included in the taxpayer's income, so we also limit our claiming on what it will be taxed on, right? So which is what? Which is 40,000, not 55. So be careful. If this statement was not there, we were going to use 55. But in other words, SARS is actually limiting us because it's this person's property. So whatever premium he charged us, SARS allowed him to claim a certain portion of what he charged us. So we also need to limit our claiming to what was actually included in his taxable income. Okay. So there is the 40 over that. So it's supposed to be 9 months. So you can correct. It's just an arithmetic error on my side. So let's work on that. And then on the rental, right, they are saying annual rental of 85,000 payable in arrears, subject to a 10% escalation after every 6 years. So this thing is 12 years. So obvious, somewhere along the line, if we're using our timeline, let's count 1, 2, 3, 4, 5, 6. So from here moving forward, the rent goes up, all right, by 10%. All right, it increases by what? By 10%. So that's a simple calculation that you're supposed to do there. Remember, just correct the 9 months. Okay, we all make mistakes. So the calculation is okay, just that I use the 9. Right, so it's 85 per month, right? You say 1,10, right? It's up to you. You can use the longer method. You can say 85 times 10%, then you say add to the 85. Or you can use this method. Because we're saying on top of 100%, we're adding 10%. That's why I'm saying 1,10. Then it's easier. Then you say over 9 months, then you get your amount.